Good morning, everybody. My name is Ilan from BetaShares. I'm one of the co-founders here and head of strategy. It's my pleasure to bring to you today's webinar, which is on Australian fixed income, and in particular, a discussion around our Australian bond fund, BNDS. Before we start off, just as usual, I want to point out that all this information is not personal advice, and obviously we appreciate anyone with interest to look into our product disclosure statements or get in touch with us directly. Before we start, as I said, a recording of the session will be sent to all attendees. In order to ask questions, you will see there we are using the GoToWebinar widget. Please go ahead and write your questions in those as we go along, and we will try and find the time at the end of the session or during the session to, in fact, go ahead and answer those questions for you. Today, it's my pleasure to be joined by three gentlemen from Legg Mason and Western Asset. So firstly, Anthony Kirkham, who is the investment manager of the BNDS fund and also the head of investment management at Western Asset Management. I'm also joined by Matt Stolbold, who is the director of sales here at Legg Mason. Anthony will be talking through the current scenario in fixed income in Australia, as well as the BNDS fund, and Matt will tell you a little bit more about the fund itself. Both gentlemen are highly experienced in the space. Anthony is one of the more decorated members of the industry when it comes to fixed income, and I'm sure you'll find his insights very valuable. As I mentioned, I am the head of strategy and marketing here at BetaShares. So today we will look to cover a few things. We'll talk a little bit about the ETF industry itself for context, and also the fixed income sector of that industry. A bit of an introduction to fixed income, and then really talk about active ETFs and how fixed income can be a useful thing to invest in via an active ETF strategy. The meat of the presentation will be a deep dive into the investment strategy and outlook for the BNDS fund, as well as really a global and domestic economic outlook. Before I hand over to Anthony, we always like to just get a bit of a sense of what people are thinking. And so I've got a live poll here for you, which just asks the question, over the next 12 months, what will you be doing with your fixed income allocation? So do you expect it to increase, decrease, or remain the same? Just wait for a few seconds to receive those responses. Second question is, what percentage of your clients' portfolios is allocated to fixed income? So you can see that there's bands of 0 to 10%, 10 to 20%, 20 to 30%, 30 to 40%, and 40% plus. Let that one run through, and I will share that with you. All right, so I'll just show you those results. The first question there was, what will you be doing with your fixed income? So certainly very few of the advisors on the line today are looking to decrease, only 11%. You can see the majority are expected to increase their allocation, and about 40% looking to keep it the same. So that's very similar to the sort of feedback we're getting from our clients, and definitely the flows in the fixed income ETF space have indicated a strong increase by clients. And the second one was the allocation. It's a bit more uniform there. 60% between 10 and 20%, but you can see there's a pretty good spread of people that are actually investing a lot into fixed income. There's 12% or 13% there, with close to 40%, and a few with almost none. So quite good to see that. We typically find that fixed income allocations are very low in the Australian market, but perhaps this audience is better informed. So with that said, I will just give you a bit of information about our partnership with Legg Mason. So we've got a great partnership with Legg Mason. We're really proud to be partners with them on 3 active ETFs, which you can see on the page there. The BetaShares Legg Mason Australian Bond Fund, BNDS, which of course we will be talking about at length today. We also do have 2 other funds, though, that are in the equity space with Legg Mason, and that is an equity income fund over Australian shares, which has got the ticker of EINC, or E-Inc as we call it, which is managed by Martin Currie, a Legg Mason affiliate. And we've also got the BetaShares Legg Mason Real Income Fund, which is essentially equities in utilities, property and infrastructure, which is known as the RINC or RINC fund. All of the 3 funds that we have with Legg Mason are ultimately income-oriented funds, one over equities, one over sort of equities on the defensive side with the property, utilities and infrastructure, and finally the BNDS fund. BetaShares itself, you may know we are now one of the leading managers of ETFs in the space. We've got about $7.3 billion in assets and a large range of 51 ETFs available. We feel that the active ETFs that we've done with Legg Mason are a very good way to invest in active management, and in particular active income in this particular case. And we're making it easier for investors and their advisors to access the high quality of investment management that Legg Mason and Western Asset and Martin Currie do day to day. I'll just start with a quick bit of introduction to the industry of ETFs. For those of you that follow us, you'll know that we regularly, monthly, do look at the industry. And as you can see, it really has been a very, very strong growth story. The industry is now just shy of $50 billion. It's around 48 billion, I should say. Strong growth rate there since 2001. Importantly, you can also see that the growth is not slowing down, so that little graph is becoming a little bit more vertical in shape. Yeah, just very, very strong growth in the industry, really across the board. And, you know, advisors are definitely a big part of that. Just for some context, over the last 12 months, there was $10 billion of new money flowing into the exchange-traded fund industry. And there's currently 243 exchange-traded products. So these days, a lot of choice for investors to go through and find their own allocations, and for advisors to help clients for those particular causes. In terms of the advisor community itself, in relation to ETFs, again, really strong adoption. So this slide is a slide that we do as part of our investment trends ETF survey, which we are involved with every single year. Again, those of you who follow us would have seen this before. But I think just worth pausing on the fact that 2018 was in fact the first year where more than half of advisors, so more advisors than don't, actually do advise on ETFs. So that's 53%, up from 27% in 2010. So it's doubling. And that represents about 9,300 advisors in the market who are currently using ETFs. And you can just see that, again, it's becoming a very, very mainstream way to invest. By context, the US market, that bar chart would be completely blue. So 100% of advisors in the US market use ETFs. We've got reason to believe that will happen here in Australia over time as well. And so traveling along to fixed income ETFs, which has been a really interesting growth story. Almost none. About 6 years ago. As you can see there, 2012, virtually no ETFs at all. I think there was just the one ETF in 2012. Now over 25 fixed income ETFs. This is Morningstar's data, which indicates that there's over $6 billion of money now in fixed income ETFs, and obviously growing fast. I think advisors are increasingly realizing that to invest in a fixed income via an ETF is an efficient way to do so. So that's a little bit of context about the industry, about fixed income, but now, of course, over to either Legg Mason or Western guys to talk a little bit about their story and increasingly about the ETF itself.
Great. Thanks, Ilan. Matt Stovall here. Thanks for joining us this morning. I'll just touch a little bit about Legg Mason before we start talking about BNDS. So just maybe a reminder for many of you, Legg Mason is a global asset management business. Listed on the New York Stock Exchange. We're one of the largest asset management businesses around the globe, and we manage over $1 trillion of assets in Australian dollar terms. Our business operates under a multi-affiliate model with 9 independent managers spanning all of the major asset classes across the world. So we're able to offer our clients products across international and Australian equities, international and Australian fixed income and cash, as well as alternative products. At Legg Mason, we're an active fund manager, and our business is focused purely on asset management. And importantly, we're a local Australian business within a large global business. So here in Australia, we have 100 staff, and of that $1 trillion of assets that we manage, here in Australia, we manage $57 billion of that $1 trillion. We're also a highly rated business by the research community here in Australia. Most notably, we won the Money Management Lonsec Fund Manager of the Year award in 3 of the past 4 years, in 2015, 2017 and 2018. And maybe just moving to the next slide then, before speaking in detail about the BetaShares Legg Mason Australian Bond Fund, we thought it might be useful just to briefly discuss what fixed income is. The term fixed income is really another name for debt securities, or the more common term that we would know, which is bonds. The simplest way to explain a bond is to liken it to an IOU. When you purchase a bond from a government or a semi-government authority or a corporation, you're effectively lending your money to them for a period of time, and in return, the issuer of the bond agrees to make regular interest payments to you, which is also known as coupon interest. and they make those payments to you for the term of the bond, and also repay the face value of the bond to you at the end of the bond's life. That is when the bond matures. And of course, there's many types of fixed income securities, ranging from government and semi-government bonds to corporate bonds, high yield bonds, to bank loans and inflation-linked bonds. As we move to the next slide, it's important to highlight the risks associated with investing in fixed income, and note that not all fixed income securities are the same. There's several risks associated with investing in fixed income securities, namely three that we've highlighted here. There's interest rate risk. That's the risk that market interest rates change, and this impacts the price of the bond that you've purchased. There's credit risk. These are the risks that are related to the credit quality of the issuer. There's default risk, which is the risk that a bond issuer defaults on its obligations. So there's different types of risks associated with fixed income investing, and consequently different fixed income securities carry different levels of risk. For example, when you invest in an Australian Commonwealth government bond, it's not the same as investing in, say, a hybrid security or a leveraged loan from a risk perspective. And the chart on this slide really highlights this point. You can see from this slide that in periods of global uncertainty, such as the global financial crisis, the September 2011 US downgrade, and the 2012 Eurozone concerns, Australian government bonds performed defensively and delivered strong positive returns, whilst other fixed income securities such as hybrids and leveraged loans, which lie further up the fixed income risk spectrum, were very weak. So these different types of risks for different types of fixed income securities really need to be considered when constructing a portfolio of fixed income securities. So as we move to the next slide, yes, there are risks associated with investing in fixed income securities, but of course there are also benefits in holding fixed income securities within an overall portfolio, and this slide really highlights those benefits. Fixed income generally forms part of the defensive assets within an investor's portfolio. They're considered lower risk than growth assets such as shares and property, and should also deliver less volatility for investors. Fixed income can provide investors with income in the form of regular coupon payments, along with relatively high levels of capital stability and, importantly, portfolio liquidity. Fixed income may be suitable for investors who are seeking to generate a combination of income and capital gains from their investments, and can be blended with higher risk investments such as equities to improve the overall risk return profile of an investor's portfolio. And when blended with equities, fixed income should provide diversification benefits and some level of protection during periods of equity market weakness. And this is because bonds often perform well when equities are weak, as they're perceived to be safe haven investments in times of heightened market uncertainty. So just moving to the next slide, let's now talk about Australia's first fixed income active ETF. BetaShares and Legg have partnered together to deliver this exciting new product to the market. The ASX code for this fund, as has been highlighted, is BNDS. And on slide 15, you'll see some important information on BNDS. As mentioned, it's Australia's first active fixed income ETF. The fund is managed by Western Asset. Western Asset is one of Legg Mason's investment affiliates, and they focus purely on fixed income investing globally and here in Australia. And shortly, you'll hear more about Western Asset from Anthony. BNDS then aims to deliver income for investors and to maximise investment opportunities from Australian fixed income markets, and investing across a range of different types of fixed income securities. And within an overall portfolio, BNDS can provide that capital stability and liquidity that investors need. BNDS provides investors with really a really efficient way to access Australian fixed income securities within the market, and with a competitive fee structure of 0.42%. and it's based on the highly award-winning unlisted managed fund that has been managed by Western Asset over the longer term, which many of you may be familiar with, which is called the Legg Mason Western Asset Australian Bond Fund. Now, Anthony Kirkham, who's the head of Western Asset, the Western Asset business here in Australia, and the portfolio manager for BNDS, is now going to speak to you about Western Asset in a bit more detail, as well as provide more information on the BNDS fund, as well as highlight Western's current macro outlook. Thanks, Anthony.
Thanks, Matt, and thanks for having me today. Just in terms of Western Asset, you can see on the slide, obviously, and as highlighted already, we're a globally integrated active fixed income manager, and we develop basically investment solutions that will deliver superior long-term investment results. For Western Asset, founded in 1971 on the west coast of the US, hence the name Western Asset. It's been an independent affiliate of Legg Mason since 1986. Very large business, 9 offices around the world, 845 employees at last count, 127 investment professionals, and in terms of funds under management, put in Australian dollar terms, over 600 billion. So it's certainly one of the top 5 active fixed income managers globally. Locally in Australia, we manage over 26 billion Aussie dollars. And in terms of recent awards, we certainly have seen a number. Zenith Professional Planner Award for Australian Fixed Income, 3 years running, 16, 17, 18. Money Management Lonsec Fund Manager Australian Fixed Income in May 18, and in fact we're going to the awards tonight with fingers crossed, hoping to make that 2019, and then also winner of the Morningstar Award in 2018. So certainly I've seen a number of awards over the years, but most particularly over the last few. The next slide, obviously looking at the investment process. We call this our rocket ship. It starts in the top left-hand corner, and it's a time-tested investment process that Western has used from the beginning. We have a value philosophy and very much a team-based approach. So when we're developing our macro and credit investment outlook, not surprisingly, we lean on that global investment strategy committee that is basically grabbing members from across the globe, including myself, to bring ideas to the table and thoughts around the investment outlook. We also use a global credit committee to develop our thoughts around credit, and then bring it all back and the ideas back to the local investment team, of which I am the head of, to basically build our base case and the alternate scenarios. Obviously, keeping in mind client objectives and guidelines, we develop our interest rate duration positions, our yield curve positioning, and also which sectors and subsectors are going to work within those outlooks. So that's basically the top-down part of our process. As you move further to the right, you can see that it's more of a bottoms-up approach, where we're starting to select securities that we believe will build the optimum portfolio for our clients. As I said, it's a time-tested investment process and one that we believe works for a value manager like ourselves. The next slide looks at our current macro outlook, and from a global perspective, we do think that growth and inflation will be moderate, but the important thing, we're constructive on both. We recognise that central banks will do whatever possible to keep the current growth profile on track, and I think a highlight of that has been this year, where we saw quite a pivot from the Federal Reserve at the start of the year, moving from, we're tightening monetary policy, to recognising that there was a need to actually ensure that current growth continued at a moderate pace, and hence the change and pivot that we saw from the Federal Reserve in basically sitting pat for now and moving to more of a neutral stance, which, as you know, obviously led markets, certainly risk markets, higher from the start of the year. And we think that we'll be in a scenario similar to that for a while, where central banks will continue to do what it takes to keep growth moving along. From a domestic standpoint, not a lot different, in that we think that stimulatory monetary policy will certainly be evident here for some time. which will certainly support growth. And as you know, there's a lot of infrastructure spending going on. We get impacted by that every single day, but importantly, that's going to help to continue our growth over time. Unemployment, obviously sitting around 5%. We think that it will decline slowly, but importantly, wage growth is going to be low, certainly from what we've seen over decades. And we think that obviously as unemployment moves lower, that will start to move higher, but it's going to be slow because 5% is no longer a point where we've got pressures building in the economy. The wage cost index obviously highlighted that yesterday at 2.3%. So, yes, it's moved off its lows, but it's still moderate when you consider where it was 10 years ago. In terms of inflation, certainly it's below the RBA target band, but they seem relatively relaxed on that. And what we've heard from them is that the main focus is now employment growth, and so employment numbers will become the focus of markets each month. As of today, the employment numbers are coming out, so that will be certainly focused on by market. The spread sectors we believe will be supported. As I said, certainly the fundamentals remain sound, with central banks, generally cautious about certainly raising rates in the case of the Federal Reserve. It would certainly be supportive of the fundamentals within credit. In Australia in particular, corporates are generally still lowly levered. So we see that as a positive, certainly for investors. And certainly from a technical aspect, we believe there's a lot of demand for yield, particularly in spread sectors like credit. And we're seeing that day to day when primary deals get done, they're very well oversubscribed. But there's not without risk. Obviously, dark clouds still remain out there. There is still a lot of debt, often sitting at the government level. And so therefore we need to be focused on those risks. And certainly trade has become another one again. Obviously, over the last couple of weeks, as that agreement between US and China hit the skids, obviously risk markets have reacted to that. Brexit still going on, obviously a new deadline now out in October, and we obviously need to see some progress there. And geopolitically, I guess we constantly come up against new challenges there, and they are impacting markets because markets are certainly nervous at this point, and certainly sometimes schizophrenic in regards to the reaction to announcement and headlines. Domestically, obviously, their major risk is the fact that house prices are or have declined. It depends on how sharp that is as to whether it remains a risk factor. At this point, you're starting to see some signs that the worst may be over, but as we know, markets can react in different ways. And I think it's also important to recognise that there's been a combination of factors that have caused this downdraft, and we're starting to move through some of those. So that's where I guess we get some comfort around the extent and the impact of that.
I'll just jump in with a question from one of our listeners here. So it is obviously, you've mentioned it briefly, but in terms of the Trump trade war and how I guess it will affect the BNDS fund or your Australian bond fund in and of itself, but also relative to equities, I'd be interested to hear your view on that. I know a lot of advisors are asking that question.
Yeah, and not surprisingly, when you have, I guess, factors like this one, which clearly impacts the forecasts around growth globally, because it will certainly stifle it, as we know and we're seeing, then clearly, people do run to safe haven assets. And not surprisingly, you've seen bond funds outperform in that what we see as a risk-off announcement. So certainly the ETF has, in terms of BNDS, has certainly benefited from that risk-off scenario. So the next slide obviously just breaks down the characteristics. It's important to say it's the same as the unlisted fund that we've managed for over 20 years. It's designed to provide income and certainly to behave like a bond fund should during risk-off periods. As said, just like what we've just seen with this, I guess, hiccup in terms of the trade agreement, bonds certainly perform in that type of environment. There's the minimum exposure to government, semi-government, obviously built in there to assist with that. And importantly, we're trying to build a diversified portfolio. So maximum 5% issuer limits on any spread type products. It's very diversified. It's an active portfolio within the Australian fixed income market. And the point here is that it is active in that, particularly with yields at such low levels and having an alpha target of, as we do, that's important when you have bond yields at such low levels. So it makes up more and more part of, I guess, your overall return within a fund if you achieve that alpha target. The next slide really breaks down the sector allocation of the fund. It's important on the right-hand side to recognise what makes up the composite index that is the benchmark for this portfolio. As you can see, there's a large allocation now to federal government bonds, 51%. If you looked at this index 10 years ago, it would be more around 20%. So it's actually changed significantly over time, obviously because the government's been issuing bonds. But that increase in exposure is not necessarily required for investors. And we, as an active manager, believe that we can find other securities, high grade, solid investment grade securities that are going to add better income for our investors in a risk-controlled manner. And so, as you can see here, we do actually have a reasonable overweight, in particular the corporate investment grade at the moment. But importantly, it's actually very much short-dated in focus. It provides yield for the fund, but obviously limits the credit spread risk. So that's important. And also equally important is that we do actually have a strong allocation to those high-grade sectors so that you are, benefiting during risk-off periods from this allocation to bonds. This can be seen certainly on the next page when you look at the credit quality allocation. This is at the end of March. But you can see on the left-hand side, there's very strong high-grade allocation to AAA, AA securities. A, triple B typically make up the corporate allocation. And as I said, the majority of that you'll find is short-dated in focus. And when you look at the average rating, when you consider the benchmark is a AA plus rating, which is extremely high, many countries across the world would love to have such a rating. This portfolio has a AA average rating. So it is there designed to perform in those risk-off periods. And the yield is obviously beneficial within the portfolio because of that allocation to credit, particularly in that short part of the yield curve, and you're getting an extra 30 basis points of running yield, almost 40 actually, because of that allocation, which we've done in a measured way so that we're still providing that ballast within your portfolio. And that's probably most, highlighted certainly on slide 22. When you break down the buckets, which this slide obviously has got a lot of detail in it, but if you follow along that corporate investment grade line, you can see there's a large allocation in the short part of the yield curve. In fact, if you want to add it up, you'll find that 0 to 5 years, 80% exposure is of our exposure to credit is in that 0 to 5 year bucket. So very much short-dated in allocation. And importantly, when you look at the government line, most of our allocation is in fact at the back end, and that's what we call hard duration. That's the ballast in the portfolio that will work for you in times of risk off. Next slide, how have we gone? Obviously the fund has only been in existence a relatively short period, but when you compare it to the unlisted fund, which as I said before has been operating for over 20 years, there's a very strong track record. Performance has met our objectives, which is key and something you want to ask all your managers, but we have. You can see there's actually 2 lines on this page. I had to look at it a couple of times wondering what we're showing here, but we're actually showing that the performance of the listed fund and the unlisted fund has actually moved in line since its inception, and I think that's really important and key to buying this product. Probably just hand over to Matt, run through some other details.
Yeah, thanks, Anthony. Maybe just some concluding thoughts before we go into question time. So just on slide 24, just to summarise, BNDS aims to earn an after-fee return in excess of the Bloomberg Australian Bond Composite Index over rolling 3-year periods. You will note from this slide that BNDS, since its inception, you'll see the performance numbers there, which Anthony has highlighted, noting that it's shorter term given the recent launch of the fund. And we did mention earlier that BNDS is based on the unlisted managed fund that has been managed by Western Asset over the longer term, and you'll note both the consistent returns of the fund and the outperformance of the unlisted managed fund versus the benchmark net of fees over a 3- and 5-year period. And then just moving to the next slide, we've highlighted here the research house ratings, which we've received from Lonsec and Zenith. Lonsec have rated BNDS highly recommended as at April this year, and they noted that despite the short track record of BNDS, they have a strong conviction in Western Asset's ability to manage this fund, having reviewed the unlisted managed fund over a number of years, noting again that BNDS has that similar investment strategy as the unlisted managed fund. And in delivering the rating for BNDS, Lonsec have also highlighted they have a very high regard for the experienced investment team at Western Asset, obviously led by Anthony, and also Western Asset's global resources, which importantly, the team here in Australia, led by Anthony, can efficiently leverage off. And then also you'll see Zenith have awarded BNDS a recommended rating late last year. So BNDS is highly recommended by Lonsec and recommended by Zenith. So just shifting to the next slide then, as to why you would use an active ETF such as BNDS when it comes to investing in fixed income. Really, we've highlighted here 3 benefits. The first one is accessibility. BNDS provides the opportunity for investors to invest in Australian fixed income with no minimum investment limits, as well as providing investors with full transparency. So investors can see the full portfolio of the individual fixed income securities they are investing in. And thirdly, BNDS provides access to Australian fixed income securities that can be done quite simply via a single trade on the ASX. And as to why use an active fixed income ETF compared to a passive ETF, the key difference is that via an active ETF, investors are getting access to a specific investment strategy that you've heard about today from Anthony, and access to an investment manager, with the case of BNDS, that's obviously Western Asset, and from what you've heard today, we believe that that's a compelling proposition. So just on the last slide before Alan takes us into some questions, in summary, here's really what we've discussed today in relation to fixed income investing and investing via BNDS. BNDS is Australia's first fixed income active ETF. It provides investors with efficient access to an actively managed and broadly diversified portfolio of Australian fixed income securities, and really acts as a portfolio ballast during periods of risk market stress. The highly defensive characteristics of BNDS really help balance an overall portfolio for investors. BNDS is highly rated and is based on the award-winning unlisted fund and is competitively priced, and the result of a powerful partnership that's working very well between 2 industry leaders in BetaShares and Legg Mason.
Thanks very much for that, Matt. So we'll just answer a few questions. I mean, needless to say, we've got a lot more information on both the Legg Mason and the BetaShares website on this fund, and for that matter, on any of the active, the active ETFs we've been talking about. There was a question that has come through just about the structure of the active ETF, and that's one thing I just wanted to mention, but we think is quite important. So the BNDS fund is an active ETF. Now you, as advisors, may be aware that some of the active ETFs have a particular structure where there is essentially an internal market maker, and as a result of that, the portfolio cannot be disclosed regularly to the investors. It is disclosed in full. That is not the case. So in the case of BNDS, the portfolio in full is available every day to the market, which I think was the first of its kind in the industry. A question more on the fixed income side for you, Anthony, around fixed income performance. Obviously, we're all aware, and I think your own results indicate that it has been a great run for fixed income. I guess the question is, in your view, does that mean it's not the time to invest, or is the timing okay still to have a look at the asset class and fixed income more generally?
Yeah, and certainly the way this fund is built out, obviously it's very diversified in nature. We're trying to capture those themes. And yes, you look at the performance, you think, oh, wow, that's fantastic. must be done. But this is not designed for that. It's designed to hold over a long period of time. As we know, nothing is really clear at this point in terms of the economy. There are question marks, and this is really there as your ballast, as your insurance, if you want, still paying income to you, but there in case of those rainy days, which, you know, clearly, as we have learned over the last couple of weeks, where we thought, okay, things are moving forward, it's going to be, you know, green pastures from here, not quite the case, and I think it's where these types of funds really come through for you, and that is really the key.
All right, well, great. Well, look, thanks very much, everybody, for your attendance. As I mentioned, everybody who has registered will receive a copy of the presentation and also the slides that we've gone through today. Please feel free to reach out to your BetaShares or Legg Mason representative for any further information about the fund. And thanks all for your attendance, and we look forward to coming back to you in the near term with some other educational content. Thanks all, and have a great day.